All right, greetings everyone. This is Eric, founder and CEO of Cubicle Investing. Definitely visit the website at cubicleinvesting.com, and there you can download my free ebook that will teach you the basics of options trading. So today is April the 5th. It's Wednesday. It's approximately 2:35 p.m. Eastern Standard Time. It's been about a week or so since I made a video. I've been busy. But nonetheless, I've still been trading. I trade pretty much every day. Again, as I mentioned before, I'm always looking to make between $300 to $500 per day. Sometimes less, and sometimes I make more. So today, so I'm on the put side. You can see here. So got a vertical put credit spread on the put side, right? Vertical put credit spreads on the put side, where I sold the 40.55 and I bought the 40.45. I put this trade on roughly around, give me a second here, things popping up. I put this trade on around, actually 12 o'clock. So I put the trade on at 12 o'clock. The price of the underlying we're talking about here is SPX. So the price of the underlying, let me pull up Thinkorswim, since I prefer the charting capability on Thinkorswim. So the price of the underlying at 12 o'clock was roughly about 40.84, 40.81, right? So 40.84, 40.81. So if we look at that on the chart, so approximately 40.84, 481. So let's just say the price of the underlying was roughly right around here when I put this this $10 wide vertical put credit spread on, where I sold 4 contracts, right? And I took in $160 for this particular position. But then I'm also in a 1 DTE trade where I sold the 40.50 and I bought the 40.44, right? So sold 5 contracts. I put that on. This is actually a rolled position, right? So I rolled this out. So I had this position on earlier where it was a 0 DTE trade, and I was at 40.60 and 40.55. Then the price of the underlying started to come down, and it got a little too close to comfort for me. So I decided to roll this 40.65 and 40.55 vertical put credit spread down to 40.50 and also 40.44. Now the beautiful thing about when you roll is that you take in additional credit. Well, ideally when you roll, you want to take in additional credit. But if the position ends up expiring out of the money, meaning that the price of the underlying does not fall below your strike prices on the put side, then you get to walk away with that additional credit that you took in for rolling your position. So as you can see here, the entire credit that I have taken in for those 2 positions is $1,180. So currently I'm up $705. You know, as you can see, it's oscillating between 705 and 690. And so I highly suspect that I'll be walking away with the entire $1,180, right? And the reason being is because, again, just having some market awareness. I'm always keeping track of the closing price at the end of the day, right? So considering that, you know, the market was down yesterday, right, a little over 0.5%, it will probably end up being down today. And again, there's no significant news on the horizon. Well, actually, Friday, there is some BLS numbers will be coming out. The Bureau of Labor Statistics will be coming out with a metric this Friday, I believe. I'm looking at my notes here. Yeah, but nonetheless, there is no major news on the horizon right now. Now, of course, there something could always happen between now and before the weekends, but nonetheless, right now things appear to be pretty calm with respect to news. Okay, and so that being said, I'm much more comfortable rolling on the put side versus rolling out on the call side. And reason being is because, as I have said before, the market has an upward bias, and also the economy is beginning to respond to the interest rate hikes that the Fed has been implementing since March of 2022, right? So the job market is tightening, and inflation is beginning to pull back. And so it's folks are speculating. When I say folks, investors are, the market is speculating that in May, on May the 3rd, when the FOMC meeting takes place to announce their interest rate hike, they may not hike interest rates. They may not hike interest rates at all on that May 3rd meeting. So, and that's what the market is anticipating. So all that being said, again, the market being upward biased, right? I am much more comfortable, constantly rolling down on the put side. So I highly suspect that I'll be walking away with the entire 1880 here. If for some reason, now I do have some overnight risk, of course, because this here's a 1 DTE trade. I rolled it from today to tomorrow, so there's an overnight risk. But again, unless there is some really shocking news that comes out, the market is probably going to open flat tomorrow, and it'll probably pull back slightly. But then again, the last few days, the last 15 minutes to 30 minutes before the market closed, it just bounces, and it starts to buyers start to come in and pump the market up. So having said all that, I'm comfortable with being on the put side. All right, so again, just 1 DTE trade at 40.50, 40.44. And then there's 0 DTE trade at 40.55 and 40.45. This definitely will be expiring out of the money, or OTM, as they say, right? OTM, out of the money, meaning that the price of the underlying SPX will finish above, my strike price of 40.55 and also 40.45. And I strongly suspect that, come tomorrow, when the market closes, that this position will also expire out of the money. So I'll be walking away with $1,180. All right, I'm back. It's the next day. It is April the 6th. It is approximately 1:33 p.m. right, Eastern Standard Time. As you can see here, so this here is that second position that I mentioned in yesterday, or in the previous video segment, where it was initially a position that started out at 40.65 and 40.55, and I rolled the position down to 40.50 and 40.44. So as you can see, the price of the underlying being SPX has increased, not significantly, but has definitely increased to the point where my position is 100% unrealized. I say unrealized, of course, because I'm still in the position and I have not closed it out, or the market hasn't closed yet. So we still got 2.5 hours before the market closes. So nonetheless, the position, if I close it out now, I could walk away with the entire 1,020 minus probably paying 5 cents for each contract. So it would be this minus 25 if I were to try to close it out now, but I probably would not get filled. Nevertheless, I'm saying all that to say that I'm just going to let this position expire, worthless. But as you can see here, so earlier on, every sector of the S&P 500 that makes up the S&P 500 was in the red. As you can see here, we're closing out the week because tomorrow is Good Friday, so the market will be closed. So we're closing out the week potentially on the upside. Right now, the market is up 11 points, and pretty much every sector is in the green. You know, with respect to energy, XL, I think B is materials, and XLY is consumer discretionary. So yeah, of course I walked away with the entire credit yesterday of $160 for my again $10 wide put credit spread. I was at 40-65 and 40-55, I believe. But nevertheless, yeah, so I'm ending the week on a nice note, and hopefully you guys are doing well. And again, if you have any questions, definitely send them to me at info@cubicleinvesting.com. Otherwise, that's it for me. Have a great weekend.